Hello, I'm Robert and welcome to my channel where I talk about everything automated algorithmic trading or simply algo trading. Today we're going to continue our discussion on order book analysis and how frequency weighting can play a major role in giving you better information. We're going to start that with today's order book. We can see here that the order book has been quite busy. Now we have the dotted price line where a price is currently at. Anything below this line is order book support. Anything above this line is order book resistance. Now this is for a long position or a long side trade, which is what we're going to talk about for the duration of this video. If you're doing a short side trade, then it's just the opposite. But for today, we're going to focus on longs. Okay, we have today's candle, and we have a fairly strong wick compared to the candle body for today's session. And we can see that the support is quite strong. So the bulls are likely to hold price pretty consistent, at least for a few days. Most likely the rest of the week. So while the bears may have a good, strong leverage point based upon the last 5 to 6 weeks, the bulls look like they're going to hold price consistent, so we will see a short-term range. For people looking for breakout strategies, that's not going to be a good trading market. But if you're looking for dollar cost averaging opportunities or grid trading strategies, then I think this week's market is going to be very generous. But we still have the potential of bulls driving price up if they can get past the bearish resistance. I think the bears are going to try their best to hold price where it's at. But this picture, as wonderful as it is, leaves a lot of information out that is really quite valuable. And that's what we are really going to focus on next. Over the weekend, I introduced the concept of frequency weighting within the order book and its analysis. And we are going to continue that line of discussion. I have modified the program since the last video to provide even more information and to give a better assessment of where the order book is and where it may go. Now we can see right away, I have rounded everything down to 4 digits. That is, I'm only interested in pip level data, not the micro pips. So as we proceed with the bid-ask pricing and we examine the spread of each situation, remember that when you open a market order, your market order is automatically going to have your price slanted against you by the spread, which is fine as long as you've planned out your particular type of trading technique. So this order book is slanted, or it is analyzing the long positions of the market. Let's get into the details of what we are actually looking at. The program is saying that support is at 1.079. Order book volume is 0.64% of the entire order book on this one price. That may not seem like much, but remember we are examining the entire order book with thousands of different orders placed from 1 penny or 1 pip all the way up to astronomical prices that will never take place. So what this process does is, rather than focusing on where price is not likely to go. It focuses on where price has been. For example, if we really look at this order book carefully, we can see that right here at 1.075, this is where all of the orders have been placed for entry positions, for limit orders. That is, people are waiting for this price to come up so that they can buy into it heavily. That's a good strategy because realistically, there's no activity down here, so they can afford to wait for a good price to come in. It's a bad strategy if you're looking to get into the market for scalping, because you need to have price retracement zones to plan out where a particular strategy may or may not work well. And that's where frequency weighting shines the best, because it counts the prices that have actually been seen, and then it weights the order book based upon that information. So we have seen 1.079 258 times, and it has a 0.64% volume level for the order book. So that is why it is given the highest weight of the order book on the buy side. That is very critical information. We want price zones to be tested. Now, if we need a stop loss, this is a horrible place to put a stop loss because it's going to get hit. Whereas down here, this is a wonderful place to put a stop loss because it hasn't been seen in over a month. And that's the level of data that this is analyzing. 1 month. Now that varies based upon the asset, the technique, and the methods for collecting data. But for this particular analysis, I'm using 1 month's worth of data. So right here at 1.075, where the highest level of buy orders are, is a wonderful place to put a stop loss because it hasn't been seen. But if you really want to go even to a better location, then you can find these smaller areas down here that would provide even better protection against harvesters. See, we can see here unusual movements right here. These suggest wicks that can take a position out. In other words, quick drops in the market that quickly bounce back. So that's an area that you don't want a stop loss, but it could be an excellent area for a purchase. And on the sell side of the market, we can see that pricing at 1.085 has 0.69% of the volume of the order book, and that price has been seen 428 times. So it's been given the highest frequency weight of this particular side of the market, or a good resistance area. Now we can see though that there are areas that have higher frequencies that may in fact be better areas of resistance, which is why you want to look at the context of a frequency zone. But basically you're looking at probabilities. Where is price likely to go? It's likely to go where it has been. And we can see price has been quite busy up and down this entire side. But right now, the most probable case of price is right here at roughly a 9 pip distance from the current market. So if our spread is 2 pips and we target this with a market order, then we're looking at making 7 pips of take profit. Now we can easily look down here for a realistic standpoint of profitability with the stop loss. And for example, this would be a 20 pip stop loss. Of course, that is upside down, but it is still reasonable enough that it could work, as I have demonstrated in the past with different levels of research. For the purposes of the 20 pip challenge, we can see that a 20 pip take profit does have merit. Price has been here within the last month. 892 times. That's quite a bit compared to other price areas. So for a take profit level, we now have some information to calculate the probability of price coming back to this point. And if we go with a 15 pip take profit, we have probability of how it might likely also be hit. Now, realistically, there are no guarantees, and the order book is as fluid as a raging river. But by using frequency weighting as a part of our technique, we can get better information about where the support and resistance zones really are in relation to where the market is likely to move. And we can see right now, this market clearly has some very interesting points to cover. Now, if the bears continue to push price down lower, then this area could become problematic for stop losses. But statistically, it is in our favor right now to take advantage of this. We also see from looking at this, both longs and shorts within the same order book. Even though we are looking at this order book from the long perspective, we can clearly see how short positions show their opportunities based upon the frequencies. So we can tell that if we open a short here, there is a good chance that this price target will be hit and then retrace, and we will likely get some level of profitability out of it. In this particular case, roughly 13 to 14 pips just on this price. Now, this particular program will be going in the Jackrabbit Relay, as it has simply proven to be an incredible resource with a wealth of information. And it will be adapted not just for forex, but for cryptocurrencies as well. So let me know what you think of this program, of the approach, and how you think this will play out in the long term. One of the most difficult things about algorithmic trading often isn't the algorithm that you use to trade with. It's the methodology for collecting the data that you need to make informed decisions. How does this type of information help you make informed decisions? Leave a comment below and let me know what you think. Please like the video, as it helps me greatly expand my reach on YouTube. If you're not subscribed, please subscribe for more videos like this. Thank you for watching, and until next time.